You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
The trading day doesn't start when the opening bell rings. Pros understand that risk never sleeps, and market-moving events happen around the clock. How can you arm yourself with the information you need to understand what's going on across the pond and how it can impact your portfolio? Welcome to the European Market Brief, your go-to source for information on the fast-moving European derivatives markets. Each episode brings you expert insights into the latest market trends, discussions of cutting-edge trading strategies, breakdowns of exciting new products, and analysis of thought-provoking trading activity. The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of Euro stocks, B stocks, DAX, and European rates derivatives like the Bund, Bobble, and Schatz, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com. So join us as we shine a spotlight across the pond and explore the cross-border volatility, regulation, and innovation that makes the marketplace so fascinating. It's time to get the European Market Brief.
All right, everybody. That music means we are back once again. It is time for yet another episode of the European Market Brief. Man, it seems like this show just started and we're already cruising through to episode 5. Thanks to all of you who've enjoyed the show, who've submitted questions, who've engaged on social media, anything you're doing out there to engage with the show. We appreciate it. You never know when you launch a new program what the response is going to be, and we're very pleased to see so many of you clearly had an appetite for all things European derivatives. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which so many of you folks are binging out there these days. Remember, if you're ready for a little additional content in your life, then head on over to theoptionsinsider.com/pro. That's where you'll find not one, but 2 additional exclusive programs, exclusive giveaways, all sorts of fun. In fact, we do have a June Pro Trading Crate giveaway coming up tomorrow on Options Bootcamp, so stay tuned for that. Lots of fun over there. Theoptionsinsider.com/pro is the place to go to learn more about that as we learn who's joining us for episode 5 of the European Market Brief. First, we go out to the Joan Rivers, to my Johnny Carson of all things European derivatives. Yes, our good friend, Mr. Russell Rhoads, beaming in from the hallowed halls of Indiana University. Mr. Rhoads, welcome back to the European Market Brief, sir.
You know, I think of Johnny Carson this time every year because he was a big tennis fan, and he would go to Wimbledon every year, and nobody recognized him because that was back in the day before, you know, everything was very, very separate. I don't think the other 2 guys on here know the Johnny Carson, Joan Rivers reference particularly
They don't.
well.
That's why I say it. It's
yeah,
fun.
she would replace him every once in a while. The only female that would ever replace them. But then she started a competing show, and they had a giant falling out. And with that, I would like to announce I'm starting a new.
That's it. He's starting his own show right now, just to twist the knife in my back. He knows I'm under the weather, and he's trying to take advantage of it there. So there you go, Mr. Rhoads there. I wonder how the Carson dynamic played overseas. I guess we'll find out, because we are joined once again on the European Market Brief, listeners, by two newcomers to the program and indeed to the network. First off, holding down the Eurex hot seat, we have Tobias Inger, the Senior Vice President out of Frankfurt. Tobias, welcome to the European Market Brief, sir.
Many thanks for having me. Appreciate the opportunity. So I'm a product developer at Eurex, working in the equity and index part, mainly responsible for benchmark indices like Euro Stoxx, DAX. So the topic of today's show. I've been with the exchange for more than 2 decades now, so kind of a dinosaur. I had the opportunity to have various opportunities to trade in London, not to trade, but to work in London, in Chicago, New York, as well as in Zurich. So capturing a lot of different jurisdictions, but also having the opportunity to look into various areas like the EM markets, and then move from EM towards the developed markets, being the benchmarks.
Sounds like we got the right guy for the show today. And then last, but certainly not least, another newcomer to the program and indeed to the network. He is Morad Askar, the founder over there at EdgeClear. Morad, welcome to the European Market Brief, sir.
Thanks for having me on.
And same question for you, sir, as our first timer. Why don't you go ahead and give our audience a bit of an overview of your background in the space. And it's also the first time you've had anyone from EdgeClear on. So why don't you also give our audience a bit of an overview. What the heck is EdgeClear?
Okay, so I started my career in trading as a professional trader about 25 years ago, trading NASDAQ SOES products. I was one of a group of people called the SOES Bandits, and we electronically front ran paper on the level 2 on the NASDAQ using the small order entry system.
So you were one of those guys. One
of those guys, day traders, lots and lots and lots of volume. And then I switched after 9/11. Things kind of changed. The rules changed quite a bit for equity. So I switched to trading futures. When I started trading futures, I moved from Boca Raton, Florida to Chicago, and got a job at a prop shop here that started out with a focus on Eurex. I started out trading actually the Dow as a practice instrument, but really the target was to go into the Euro Stoxx 50, and then the FDAX was my main product. Eventually, about a year later, I became profitable, maybe 7 or 8 months doing that, and I traded equities for 2 years before that, so I came with some experience, and then I started my own prop shop, also at the Board of Trade, and we traded about 10% of the DAX volume on a daily basis, just very heavy kind of volume click trading. We did about 8% of the Bund and about around 8% of the Euro Stoxx on a daily basis. We cleared Advantage futures at the time when they first started out. So that's where I came from. Since then, I started to become known online as Futures Trader 71 on Twitter, and I just kind of parlayed that into a brokerage, and now I'm the founder of EdgeClear, among other companies. EdgeClear's been around for 5 years. We clear trades. We're an independent introducing broker right here in Chicago, and we clear Eurex, of course, but also we have CME Group, ICE, Singapore Exchange, Osaka, Hong Kong, Montreal. All of those are products that we support, or exchanges that we support. Our main products for Eurex are really the DAX, the mini DAX, micro DAX, Euro Stoxx, micro Euro Stoxx, and the Bund and Bobble. It's this, and we add products based on customer demand. Our main focus is retail, pro-tail, with some institutional and some DMA or direct market access traders, but our focus is really the pro-tail segment. This is the guys that came from prop shops from London and whatnot, and want professional clearing and support. So that's what EdgeClear is, and that's who I am.
All right, then. With the crew assembled, I think it's time for a little Continental conversation.
It's time to catch up with the thought leaders who are shaping the European derivatives markets. It's time to have Continental Conversations.
All right, everyone, welcome to Continental Conversations, the portion of the show where we dive into an interesting topic or market segment and explore it in a little bit more detail for you, the listener. At the end of the day, this show, listeners, is really a grand tour of the various European markets. We've talked about a lot of them already. We've gone on quite a few interesting quests along the way, and you could probably deduce, if you read between the lines there in the intro, we're going to be talking today about the DAX, which means we're heading over to Germany. You know, why Germany? Why should we have a stop in Germany today? Well, you know, at the end of the day, it is still Europe's largest economy. At the end of the day, when you want the true economic engine, the powerhouse that drives the machine over there in Europe, you tend to head towards Germany. Russell, same question for you. If you're listening to this as a typical, let's say, U.S. retail trader, and you're saying to yourself, you know, this show is fun, this show is interesting, but why should I care about all things Germany, let alone DAX? Why should that interest them, Mr. Rhoads?
Well, Germany dominates the European economy, and the guys over there know that much better than I do. But not looking at the EU as an economic bloc, but Germany by itself, it looks like it falls right between China and India, two countries I would not want to be between right now. But they do. But on a list, they fall right between them. So it's the largest it's the third largest economy in the world. It's also, you know, by far dominates the European economy. So I would almost say, as Germany goes, the rest of the continent goes. So it's something that you want to pay close attention to, just with respect to from a macroeconomic standpoint.
It's almost crazy. It took us 5 episodes to get to Germany, but we're finally there. Tobias, same question for you, sir. If you're a typical U.S. trader and maybe you're curious, you're intrigued by these German markets and you want to know a little more, why should they care about all things Germany and indeed the DAX, sir?
Well, from my perspective, there are a lot of things to be considered. So Russell already said that Germany is the 4th largest economy in the world. So it drives a lot of what's happening in Europe. The same time saying this, if you look at the DAX 40, which is the index you're talking about, comprising the 40's largest companies in Germany, they are highly exposed towards the global economy, much more than most of the backbone of Germany, which is usually what is called Mittelstand or mid-size and smaller companies. And this gives it a very special touch. Further, I would say it's also great diversification from a US perspective to get outside of your own country. And this is in Europe probably a bit different as we are relatively small also in size, but also in terms of markets. We are, each alone is smaller, but as a whole, it's very interesting to have different opportunities. So diversification probably is the second aspect I would point out as a reason for trading also in the German DAX.
And Morad, last but not least, sir, same question for you. Why should a U.S. trader be interested in these markets? And also, from your perspective, boots on the ground, you're dealing with a lot of U.S. traders. What level of interest are you seeing right now in all things DAX, sir?
So the interest in Eurex products in general, specifically the DAX, it ebbs and flows. I mean, the changes that have occurred since the new administration has taken over has shown a light on Germany, right? This big defense package. It's the growth area, right? Yes, the S&P 500 just made new all-time highs and so on, but the action is kind of shifting back to Germany, to the DAX, also some of the Euro stocks issues, things like that. I think this is a very timely show, actually, because we are getting more inquiries into the DAX micro and mini. And the volume hasn't really picked up all that much. I mean, remember, the context of my information is day trading. and handling retail, pro-tail versus, fund managers and so on. And to me, as a trader myself, Eurex has always had a special place in my heart because it's where I made a lot of my money as an active trader, but also because I feel like Eurex provides a very clear and egalitarian cost structure versus, say, CME Group, where I'm a member of the CME as well. I get different pricing and things. Things are not everybody's the same in some of these exchanges. But we do like to promote the DAX in terms of those people who are kind of been run over by the NASDAQ quite a bit. The NASDAQ tends to trade very aggressively. The DAX is a little bit more calculated, I think. And those people who get tired of the S&P 500, let's say, the Euro stocks has always been something that I like to talk about as a great alternative. It's cheaper to trade. It has ample liquidity. It's very technical. And another thing that I want to throw into this is from a day trading perspective, the correlation, the spread ratio between the DAX and U.S. products is the lowest I've seen in my career. Really, these products, the DAX used to track the YM or the Dow Minis and the S&P, upwards of 90% on a close-to-close basis. Currently, it's sitting at like 64%, 65%. This is an opportunity for diversification. Like if you're already heavy into the U.S. markets, going to the DAX, going to the Euro stocks is a good way to just get away from a very competitive market, in my opinion.
We've had some fortunate timing on this show, and it seems like it's continuing. But fortunate timing from a vol perspective, and now from a correlation perspective. Have at it, Mr. Rhoads.
Yeah, you can tell. Just to kind of coattail on what was just being said, when you look at the composition of the DAX, not a whole lot of technology. I think there are 2 technology names. Is that right? There are no energy names in the DAX. So right there's 2 things that make the DAX, just from a portfolio basis, not even taking region into account, very different than the S&P 500 or pretty much any other index in the U.S. There was one other big difference in there that I had, and it slipped my mind. You guys might know what it was, but it also there are nice differences between the DAX and the CAC 40 and the DAX and the Euro Stoxx 50. Both of those other indexes have an energy component. There appears to be a bit more consumer discretionary in the Euro Stoxx and the DAX than the CAC. There are lots of composition differences, and when you're thinking about things from a diversification benefit, in fact, I was talking about this last night in class, that I was talking about bond stock diversification, and you don't want to just look at the historical relationship between the 2. You actually want to dig in there and see what's in each portfolio. And there are some significant differences in the DAX and the other European indices portfolios when you can compare them to the U.S. markets.
Well, Tobias, let's drill down into that a little bit. We've touched on the DAX a little bit. Obviously, you broke down that it's 40 names, so very different than the S&P 500 right there. Russell just broke down that there is no energy component in the DAX. What are some of the sectors that are available in the DAX and some other key components of this index that our listeners should be aware of, Tobias?
Yeah, thank you, Mark. That's a good question. I mean, being German, usually the answer is beer and cars. However, the main sectors are industrial goods and services. So this would be companies like Siemens, Airbus, Rheinmetall. They make up of roughly 25% of the DAX. And this is already followed by technology, close to 19%, as Russell pointed out. Just 2 companies, but one very big one, which is SAP. So I guess also a street name in the competition with Oracle, for example. And the third largest would be insurance, Allianz Munich Re, with around 13% share. The last one I would like to mention is telecommunications with Deutsche Telekom, which makes up of 7%, and Deutsche Telekom is the mother company of T-Mobile in the US. So I guess also a name lots of retailers would know. The cars, like BMW, Mercedes, Porsche, they make just 4.5% of the index right now. So when we talk about diversification, I guess we get a really good mix on this, as Russell already pointed out, and much different to what we see in the US.
And we should point out this is a total return index as well. Really quickly, give our listeners a bit of an explanation. What are we talking about, the total return index, Tobias?
And a total return index basically includes any return, including the dividends. So if you have the S&P, for example, it's a price return index. You just trade the move of the underlying shares, excluding any kind of dividends. If you have a total return index like the DAX, you assume with any dividend payment and a reinvestment of this dividend into the index. So for the DAX and for a trader, this makes it not more complex, but you have to have an additional consideration, meaning you have to include the dividend once you make the pricing also for the futures. This is, I think, a very important aspect when it comes to what an investor would like to have. It's always a total return. So if you buy any share, you include the dividend payments as part of your return, and this is then given by the DAX, which is giving you the total return of whatever your investment would be. So very clean on that end, and I would say also in favor of the retail investor. The other interesting point is it's an ever-growing index. So if you compare the development between the S&P and the DAX since 2000, I guess the S&P was around 1,000 or 1,500, I don't remember exactly. The Eurostoxx was around 5,000, which is a price index as well. And the DAX is now at 24,000 index points. The Eurostoxx is around 5,500. It didn't move in terms of price, while the S&P is now at 6,000 roughly. So you see a difference also in what the index increase will come over time due to the accumulation of the dividend.
All right, and Morad, as our boots on the ground guy, if I'm one of those pro-tail traders you were talking about earlier, and I'm listening to this and I'm a little intrigued, I want to maybe engage with these German markets, what products can I trade? What's available to me over there if I want to trade the DAX?
Really, the FDAX itself, the main product, the original product, also the mini DAX and then the micro DAX are available. Those come with, just to run. I'm a statistical trader, so technical and statistical trader. The DAX will do somewhere around 40,000 contracts a day. The first standard deviation of DAX volumes like 43 to 24. If you go down to the DAX Mini, it used to be very, very little, and we see that's grown quite a bit. The volume is 34,000, so 39,000 for the main product, the grandfather product, and then the Mini is now up to 34,000. So very, very tight. So you can see there's more interest in the smaller product. The micro is not picked up as much as the Mini has, but that's available too, and it comes with different tick sizes and so on to suit the account size. The catch with the DAX is that it is it's the highest margin product that we offer at approximately 31,000 euros. And folks can trade it for about 7,700 euros per contract. So you need to be pretty well funded coming into the DAX. If you step down into the mini DAX, then things are a little bit less pricey in terms of margin escrow or the amount that has to be deposited. This can of course be traded in the DAX. There are folks who trade the DAX, or used to be a lot more, trade the DAX versus the Dow and the NASDAQ. But like Tobias said, the correlations, it was Russell who said that the composition is so different now that those correlations can be quite wacky. Trading the Dow DAX spread is not it's not fungible. First of all, meaning you have to put up margin on both sides, but also it can be quite erratic. For the trader that wants a lot of adrenaline, that's a pretty good way to do it.
That's a good point about the margin. That's definitely for the pro tail side, not for your proverbial grandmother from Iowa who wants to dabble in a little bit of DAX.
Right.
A little bit more capital involved there. Well, obviously we're focusing on the futures for this show, Russell. But you had some interesting findings you discovered as you've been digging around on the near-dated options side, which, again, not available for our U.S. listeners, at least not yet. But still some intriguing findings there, sir. What did you unearth?
Well, and I think this is a function of the usage of daily index options in the U.S. versus in Europe. But we all are taught that over the long term, option sellers will eke out profits over a long period of time. If over the past year and a half or so, you had sold a one-day at-the-money straddle on the S&P 500 or the NASDAQ, you would have not done particularly well. In fact, I'm consistently long index straddles in the U.S. right now because I think there's so much systematic selling of them that it's very difficult to make money from the short side. That's not true for DAX options. And I track the daily at the money straddle performance for the Euro Stoxx 50 and the DAX, and then 3 indexes in the US. And I've noticed that option sellers in Europe seem to be doing better than option sellers in the US. And actually, it's a profit for sellers in the US versus losses for sellers of the S&P and the NASDAQ. The Russell 2000, I don't think there's a lot of systematic selling there. So that's kind of an outlier in the US. But if you like harvesting that volatility risk premium, just for instance, in the most recent 3 months, selling an one-day at-the-money straddle on DAX in April would have about broken even. You would have lost hundreds of points doing that in the S&P 500. In May and June, I believe about 400 points of profit in May and about 700 points of profit in June, which again did not hold up for the U.S. indices at all. So there's this difference in price behavior for the short-dated options, and I think it's really the usage of short-dated options in the U.S. is a lot of people coming in and trying to sell them every day, and it has suppressed the volatility to a point where buyers can actually make money off of those right now.
That's one of the fun things about doing this show, Russell. We've been uncovering a lot of interesting and surprising correlations and discrepancies between these markets, which at the end of the day, that's the whole purpose of this show. That's why we're doing this. If everything traded the same as everything here in the U.S., there'd be no reason to have a show like this. But we're seeing from a vol perspective, from a correlation perspective, now as you're mentioning from a near-dated options perspective, things a wee bit different across the pond. Before we roll on out of this segment into the overnight desk, Morad, you made some interesting points on the margin front. It's not always the sexiest topic. I kind of refer to it as the plumbing of the futures world in particular. Not everyone likes to lead with margin talk, but when you start trading it, it's obviously a very important issue. So hit us really quickly. Any other highlights you want to mention about the margin size or the contract specs when we're talking DAX, sir?
DAX, we covered margin, it is quite high, but, this is a 25 euro per point product that has an average range over the last year and a half of about 243 points. And so it's about 5,000 euros per day of range. But, as a day trader, I'm not going to buy the low and sell the high. I'm trading everything in between. With the DAX, you get a lot of rotations. So you end up with a tremendous amount of upside. Again, this is a leveraged product. Derivatives trading is not suitable for all investors. I'm a broker. I have to really point that out. and also the lower margin you use, the more leverage you use, and so the probability of ruin increases with lower margins. We're very margin responsible as a broker. Like, we don't do the crazy day margins like some others do on U.S. products, and most clearers for the DAX and for Eurex products, really they don't go below 25% of the intraday, the exchange initial margin. So I think this is really someone who's got a program or a strategy that is very, very strong and has good risk controls. To me, the DAX is just a much more, let's just say it provides more opportunity than something as crowded as the NASDAQ or the S&P. I really believe this market's overlooked, and there isn't enough in terms of awareness to the trader, especially the day trader segment. So that's the key. I think there's plenty of volume, plenty of liquidity, and good range in this product. You have something that works well. The mini DAX are really, really good products to kind of step in and see if your program will perform.
Well, I think we have uncovered that there are a lot of interesting opportunities afoot over there in the German markets. And speaking of what's going on in those markets, let's get to that now as we check in with the overnight desk.
What's lighting up the tape in the European derivatives markets right now? Let's find out. It's time to check in with the overnight desk.
All right, and welcome to the Overnight Desk, the portion of the show where we get into a little bit of what's lighting up our tape out there in these markets. And Morad, we'll start with you as our boots on the ground guy. You were just kind of talking about the margin and some of the interesting correlation opportunities that exist right now as we're recording this show. So very timely out there. What are you seeing from a client perspective right now? Are people taking advantage of this moment? Are they starting to dive into the DAX in larger numbers? What are you seeing from an end user and client interest level right now?
We're in a volatility market regime, which means that, we were in a monetary policy market regime where, what the Fed said and which way Jerome Powell woke up this morning kind of moves the markets versus, we know what the Fed is doing. We know what the dot plot looks like. Lagarde has been very forward speaking and very open about what the ECB is looking for and how it might respond depending on how things play out. A volatility regime is a different ballgame. A volatility regime is what you had during the, what do you call it, the Great Correction or whatever that was from the real estate bubble in 2008.
The Great Financial Crisis.
Yeah, the news is what drives things. And the news currently is U.S. against everybody else, right? This tariff war is interesting from someone like me who has a background in economics and so on, like the idea that we're going to make them pay tariffs. Those Germans need to pay our tariffs. So every day what's happening is we're seeing a lot of news-based activity. And unfortunately, it's not through the standard official channels. It's through social media. So you get these bombs and mines that kind of drop. And the DAX responds quite well to these, in my opinion. I think that my point is being that there's this kind of friction between Europe and the U.S. currently from a political perspective. It's much harder to trade that kind of activity with a product that has an underlying that opens at 9:30 Eastern. Whereas you can have exposure to a product that has a full underlying trading and being arbitraged in the European markets when the Europeans respond. So what we used to do is, trade the S&P at 2 a.m. Chicago time, which is when the indices open in Europe. Now you don't really need to do that. You can go directly into the DAX and take positions if Germany is affected by the news, whatever news that is. So that's where we see the interest come in. Like, hey, maybe I should have some exposure directly in European products in euros versus trading a proxy, which is the S&P 500, NASDAQ, or other products that are traditionally traded from the US side. Also, the movement has been bringing in European customers looking to trade European products, which we also do. We open European accounts, and that's been interesting. So for us, this has been an interesting time when it comes to the DAX and other Eurex products.
And you mentioned earlier a lot of your DAX clients in particular. They're day trading these. They're coming in, they're getting out. It's been known as, I suppose, a bit of a jumpy contract, to put it mildly out there. Is that pretty much what you're seeing right now? Very short term. What kind of holding period we're looking at here with these DAX futures?
DAX, you're looking at most folks when we run our EdgeWatch product, which is a product that we create where it pulls everybody's fills and we can run analysis to understand what our risk exposure is as a brokerage and also how people are performing. We're seeing folks holding for anywhere from 15 minutes to several hours. We don't have anyone that's swing trading any of this stuff, which, my guess is this would be kind of more of Russell's territory of just putting on positions, like he said, and options and so on. For us, they're in and out, and they're dealing with this volatility, and they're responding to how the market's trading momentarily using order flow or auction market theory or just technical analysis.
All right. And Tobias, as our product man over there at Eurex, we've been talking for a while about the trend, not just in European markets, but across all markets, towards smaller, more bite-sized contracts. The smaller, the better these days out here, Tobias. So what can we get on the micro and mini side from a DAX perspective? And we were talking about margin earlier. Any margin, maybe pros and cons you want to add to that conversation, sir?
Yeah. So when it comes to the product suite we are having, so the micros are the one where we see the most inflow from retail investors. So there we have more activity, and the growth rate is quite promising. So year on year we have around 30% growth, and the ADV is around 28,000 this year. So it's picking up in interest. And given the size, it's €1 per index point, meaning you have a contract size of around 24,000, while the mini DAX is already with a multiplier of 5. So you're significantly larger. The margin requirements at Eurex are basically the same no matter which contract you're trading. So it's around 7.2% margin, initial margin payment we are asking for. However, and I guess it's also important to understand, is that we do have a portfolio margining system. So if you trade the FDAX against the mini or the micro, you of course would get basically nearly 100% off. However, if you trade against the Euro stocks, this is also being considered in terms of margining. So you will get offsets, which makes it much more cost efficient for traders, as the correlations are also not 100%. So if you look at the 25 correlations for the DAX against other products, then the Euro stocks around 95%. So you have a different profile. Then you talk about the S&P, it's around 58%. So complete diversified, and this is what we already discussed. So this is, I guess, a very important aspect that no matter which contract you trade, you get a very decent liquidity. So the spread is around 0.8 bips in any of those three contracts. So the liquidity provision towards end clients is quite decent. And in 25, the spread of the microdex actually is slightly better than of the other twos. So from a signaling point of view, I would say For retail investors, the micro is the one to go and where we see the largest growth from this clientele. It's a very attractive opportunity to trade the European markets.
All right, and Mr. Rhoads, as we check in with the overnight desk, obviously we just saw the Fed and Powell, even though it seems like we see the Fed and Powell saying something just about every week, but that's obviously driving some flow. We've talked for a while on this show as well, the discrepancy between the ECB and what we're seeing here domestically on the rates front and how that could potentially open up some trading opportunities. Are you seeing any resulting activity in the DAX, sir?
Well, not at the moment, but I do want to, and I did some work while you guys were talking, and I just want to make sure I get my numbers correct here. Just looking, the risk-free rate in Europe right now is 2%, and ours in the U.S. is 4.5%. So these numbers don't necessarily match up. But right now, using the Bloomberg, OIS numbers, it looks like we're going to get one cut in Europe before the year is over with and two out of the U.S., and that the spread between the two should narrow by about 50 basis points between now and about a year from now. However, we're going to get a new Fed chief over here. And I think, the amount of coordination between the U.S. and other countries, I don't know if that's gonna bleed over to the Fed and the ECB or not, but it might create, some different situations in the two different regions that cause the indexes to spread out, come back together, et cetera. So everything usually comes back to what's going on interest rate wise. And it will be interesting to see if what we see right now being priced in, if that changes dramatically when we start to get hints out of President Trump as to who he wants to put in Jerome Powell's spot next year. It could be somebody that's is very mercantilist and only wants to focus on the U.S. Who knows? But I would be keeping an eye on, if you're trading both markets or both markets versus each other, I'd be keeping an eye on that development. You'd think that it only impacts the U.S., but it is going to impact the world. And then, Morad, I don't mean to correct you or anything. I used to run a CTA where I traded nothing but stock index futures, and I traded CAC, DAX, and the Eurostoxx 50. I had a systematic approach where if you're making, basically in a nutshell, if you're making a new high or a new low in the last hour, you would expect that to follow through and you would trade it with a stop. One of the great things about doing that was I got a close in the middle of the morning in the US every day. So if you're trading, NASDAQ futures, trading S&P futures, trading Russell futures, and things are slowing down after the first couple hours, we have another market that is experiencing end-of-day volatility, and it's something that you really should be taking a look at.
Yeah, I agree.
Well, before we roll out of this segment really quickly, I don't think we've touched on it. So Tobias, hit us quickly. What can we look at in terms of hours if we want to engage with all things DAX on the futures side? What hours can we trade over there, sir?
So I looked it up to have it in the US Eastern Standard Time. So we basically grant you a dinner, and the start of trading is at 7:10 p.m. Eastern Time, and we end with the US market close at 4 p.m. So we have a closure around 3 hours, and the rest of the day it's fully tradable around the clock. And I guess this is also having the idea of being a global market and covering the global economy on that. So you can trade whenever you want.
There we go. A lot going on in the world of the DAX. A lot going on with the show. We're already coming up against it. We have people who have been listening for a while and have been patiently sending in questions. We didn't have time to get to them on the last show. Let's see if we can really quickly squeeze in a few now as we dive on into Answer the Red Phone.
What's on your mind as you're navigating the wild world of European derivatives? Let's find out as we answer the Red Phone.
All right, everyone, welcome to the Red Phone segment. This is, of course, our listener question segment. We tried to get to it last episode, but, we ran long, as sometimes these shows do. But interesting questions. That's why doing this show is so fascinating for us, because you come from all different perspectives and you're interested in all different markets Let's start here with this one from N. Nance. This came in during our last show. You said the European FX market has gotten much quieter since the onset of the euro. Gone are the days of the lira and the franc and the Deutschmark. Instead, we have the euro USD and now the pound USD with a few flirtations with the Swiss franc and others. Now, it seems like the landscape is much more barren. Volatility is low and the opportunities for interesting crosses are few and far between. Am I just pining for yesteryear, or did we lose something in the European FX market when we sacrificed so many national currencies on the altar of the euro? Wow. Well, first off, you get the award for a very well-written question, and Nance, you clearly put some thought into it. So thank you for taking the time to send that in. You know, we haven't really had a chance to do a full episode on FX yet. I'm sure that is a product area we'll get to down the road here. But you raised an interesting point. I should point out really quickly, when I started my my trading career right out of college, I was considering getting into the FX side of derivatives back then. And even then, when the euro hadn't even come around yet, it was just in the offing and the planning stages. You could even see then that FX desks were being slashed across the board. And it became very obvious to me even then, maybe I should look at the equity option side instead of the FX option side. So I think there might be something to that in terms of having lost some of the intercurrency volatility that used to make the FX market in Europe so interesting. Morad, you've been on the futures side and indeed the European side for a while. What do you think? Do you think our listener, N. Nance, are they on to something? Did we lose something from a trading or maybe from a volatility perspective, getting rid of all of those currencies and just going to the euro? Or is, as they point out, are they just kind of looking at the past with rose-colored glasses?
Wow, you're really setting me up there.
It's a great question. They set us up.
Yeah, I mean, it's funny because just yesterday I was having a discussion with a really big treasury trader, a spread trader here, and he said, you know, Germany should have held on to that mark. You know, they shouldn't have gone into Euro. I'm like, if Germany pulls out of the euro, the whole thing is just going to fold. But I do believe that there are look. As a professional trader, I could tell you, and it's just, I'm stating the obvious, I'm sure, to everybody here, you don't make money where everybody is, right? You don't make money in the middle of the curve, in the middle, in the 1 sigma of the histogram. You make money on the edges. You want things to be off by 1 or 2 or 3 or 6 standard deviations. That's where the big money's made. And so when you add different currencies, you create more opportunities for things to get disjointed. So yes, absolutely. It makes it so that you're not trading this monolith, you know, in Europe versus a monolith in the US versus, you know, all these big currencies everywhere. But I think Europe would be having grown up in Europe and actually, you know, come to the US from Switzerland, I think that the euro had to happen. I mean, the European community had to start operating as one big economy, and that's provided a lot of stability. I mean, it's provided quite a bit of opportunity. So I don't know. It's true. From a purely trading, investing point of view, you want to have as many products or differences as possible. And that's why exchanges go from monthly options to weekly options to every Wednesday options to daily options to zero DTE. Like, you're adding more opportunities to make markets or to trade mispriced opportunities. So, yes.
Fascinating question. Russell or Tobias, anything you want to add here on our friend asking about perhaps the lost halcyon days of European FX trading?
Oh, I was just going to say, you know, we went through it. When I first started at the Merc on the floor, the segment that was dedicated to currencies was doing quite well, and I don't think it was necessarily the switch over to the euro as there was a period of time, we've gone through different types of things. I love that Morad brought up the So's Bandit thing. I was going through books last night in my library and just couldn't throw away the So's Bandits book that I have, even though it's almost 30 years old. But one of the things that was kind of a retail type fad was spot FX trading for a while. And I feel like what may have happened is traders that would have, and I never traded spot FX, but as part of the CTA that I ran, I did trade the currency futures. And I feel like some of the liquidity started to get sucked out of that market. And if institutions suddenly don't have the pro-tail retail type money to provide liquidity in that market, they probably started taking a look at over-the-counter solutions for their currency risk. And that's why we don't see as much listed currency trading as we used to. That's why it's something I've thought about in the past. I sure didn't make that up on the spot. But that's what I think. That's why I think maybe we are where we are with respect to listed currency derivative trading.
I think Morad makes a good point too. Sometimes the things we want as traders that are better for us are not necessarily better for the economy or for the world as a whole. We like a little vol as traders. That cannot be the best thing for the world as a whole sometimes too. So sometimes the two desires are at crossroads sometimes out there. Well, great question. And Nance, thanks to everybody who takes the time. We'll try to get to more of you on future episodes of the show. Unfortunately, that music means we have come to the end of yet another episode. Man, time flies when we're talking all things European markets. Another fascinating journey, this time across the pond to Germany and to all things DAX. But before we head out, Tobias, we'll start with you. If our listeners are intrigued, they've been hearing us talk about the DAX throughout the entire episode, and they want to learn a little more, where should they go? What should they do, sir?
So first of all, they find a lot of information on our website, www.eurex.com. For the index itself, it would be www.stocks.com, so stoxx.com, where you find all the information. And my name is somewhere on the webpage, so happy to answer any questions directly.
I like it. A brave man offering to answer them himself. So hit up Tobias over there at Eurex. Of course, eurex.com. EUREX.com, the place to go to begin all of your journeys after listening to this show, listeners. All the product stuff we're talking about on this show and a whole bunch more we haven't gotten to yet, all including FX, waiting for you over there. We'll have to do a fun show diving deep into the mad world of FX on a future episode. And Morad, you did a great job as a first-timer here on the network. If folks are intrigued, they want to learn more about all things EdgeClear, where should they go? What should they do, sir?
Simple, edgeclear.com, edgeclear.com. It's all there. You can look at our contract specs. If you're interested in the DAX or whatever, you can click on the DAX to go directly to the Eurex page, connected to that. You can find me online as Futures Trader 71, Futures Trader 71 on Twitter or X as they call it. I'm happy to engage there as well.
There you go. Check them out over there at EdgeClear if you're looking for a way to actually trade these products that we're talking about here on the show. And last but not least, Mr. Rhoads, if they're intrigued, maybe they want to check out some of the research you're cooking up on trading European vol versus US vol, or maybe some of these European options performance versus US. Where should they go? What should they do, sir?
Oh, just continue to just watch all of your programs, because I'll just keep showing up over and over again. But otherwise, because I'm on here at least once a week, I'll see you again Friday. But probably anything I do, I put out on Twitter, and my Twitter handle is just my full name, Russell Rhoads, 2 L's, 2 S's, and RHOADS, not the news guy in Tampa.
Not the newsman in Tampa is his tagline. Check him out. RHOADS is the way to find him. I'm under the weather, listeners, but I did manage to survive another full episode. That's going to do it for us on the European Market Brief today. Not going to do it for us on the network, though. I'll be back in a few hours. No rest for the wicked with a bunch of great guests to talk all things advisors and options. Should be fun. Then we're back with our usual array of content throughout the rest of the week until we're back very soon with another great episode of the European Market Brief. Stay safe out there, everybody.
The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of Euro stocks, V stocks, DAX, and European rates derivatives like the Bund, Bobble, and Schatz, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.